So I'll start with, okay. Let's start with the probability of bounces. Okay. So if you look at this, actually, I mean, these are certain good things about market Smith. It says that the 50 simple moving average is about 10.7% from the 50-day moving average. So that's the 50-day moving average. So that's how you can figure out how deep the correction is so far away from the 50-day. And right now, I mean, until yesterday, that's about 12.5%. So generally, whenever these things, either side of the 50-day moving average, when it goes over 12% or 10% or over 12% or 10% to the downside, you would generally get some kind of bounce. That's what I have been expecting. That's why I haven't been doing any trades since yesterday, because right at this price, after we get into a short, bear market rallies are really sharp, and then our positions could, especially the options, could directly go to zero. So that's why I'm being very patient right now. But so one of the things that we can expect is either it moves sideways. If QQQ moves sideways and the 50-day moving average starts to move lower, that would be the worst thing that could happen right now. After such a big move lower, expecting a sideways move is probably the most bearish bearish price action we can see. So that's one of the reasons why I'm not getting into new trades, and we have to see some kind of bounce. That's what I'm expecting right now. And I was saying before I started recording, according to based on the history of how the corrections have been, whenever there is a correction from January to May, that generally continues until the end of October. So we do know in most of the years, the worst months have been September and October. So most probably, I mean, think about waiting for another June, July, August, September, October. That's another 5 months of this sideways or, bear market rallies and the pullbacks to the lows. I mean, this could be a long year. That's what I have been saying for a while. And the other thing is the interest rates. Let's talk about the interest rates. So whenever oh, it's not here. Okay, let me go back to. I am brushing up on a lot of fundamentals, while the market is going down, or how the the analysis is done by the guys who does the fundamentals, or who does investing based on fundamentals. So every time this 10-year is up about 1.5% this year. So anytime the 10-year goes up, when it says 29.93, that 10-year is 2.993. Okay, so this is this is 10 times of the regular 10-year yield. So according to the discounted cash flow, I mean, I don't know how it's done, but the simple thing that I understood is every time there is an increase in 1% in 10-year yield, the NASDAQ will go down by 20%. Actually, it's actually 21%. So right now, 10-year is at 3%. If this goes to 4%, we'll see another 20% drop in the NASDAQ. That's how they calculate, or the valuation of the stocks will go down. And right now it's in between 21 and 31 right now. So again, we don't know how far this is going to go. Right now it's about 3.2 is the resistance. But if that breaks, I don't know how far this is going to go, but inflation is already at 40-year highs. So even 2000, it was at 6%. So when I read these things, these things give us the perspective of what to expect from the market. So obviously, I have been covering that the 10-year treasury every day. I'm watching the 10-year treasury, and also this is the bond. I don't know if I'm assuming everybody knows this, but I'm going to repeat it anyway. So when the bonds go down, this is the 10-year treasury bond, the yields go up. Yield is TNX. So if you look at the 10-year bond support, it's actually at the 2018 lows. So the next one, I mean, we do have a few supports here. We have the next biggest support here. And when you look at this one, this was a huge move. And, it went down so much. It's at what? Anything below 30? That's not RSI. Okay, hold on. What's the RSI here? 22 right now. It says right here. The RSI is around 22 right now. So anything below 30 is generally considered oversold, and it's way, way oversold. And we are not even looking at the daily. We are looking at monthly. And if you look at the past, we never had this kind of moves, obviously, which makes sense because of the high inflation that we have right now. So, I mean, this could go down here or here. We do not know. I mean, this is one of the reasons we need to keep these treasuries and, the yields and also the treasury bonds in front of us every day. And if this thing gets worse, and I was expecting this bounce, and then the idea was that when we get a bounce in the bonds, the yields would go down and the market would also get better. So yesterday, when I got long on Friday, I saw this and I thought we're going to get a bounce here and NASDAQ is going to turn around, but that did not happen. Okay, I mean, we had this relationship work until now and it did not work yesterday. So, and these relations they work only until they work, maybe the relationship is not broken yet. This is one of the reasons why I think we should get a oversold bounce in the markets and also in the bonds.
So KP, this relationship is not always true.
Well, I mean, it doesn't always work. I mean, so I'll tell you something else. So some certain things that are easy to understand. So generally, when the dollar goes up, this is the dollar against the dollar index, again major currencies. When this goes up, we know that crude goes down, but that did not happen. That's because of inflation. I mean, generally there are more than one relationships that are at work. So you will follow up certain things, and as long as it makes sense, you trade based on that. I mean, see what happens is every time there is a relationship does not work, we can come up with theories or we can figure out why it's not working. But again, that's not going to make us money. So our job is to make sure that when there is a relation, follow that relation. And as long as that holds on, you are good with the trade. When that thing changes, obviously, you have to consider other possibilities. I used to do this bullish divergence. This is bullish divergence. What that means is when the price goes to a new low, RSI is actually making a new high. So this could still be working, or something is not right. Anyway, so you can see it, right? So while the price is going lower, this is moving higher. It means that there is the higher probability is for the price to move higher, or it could probably come down and make a higher lower high and probably moves higher. Next, I wanted to talk about what this is something everybody would be watching. Everybody, all the money managers and everybody. So we have this 3,800. That's the 38% retracement. There are too many lines on the chart. That's why I got rid of the extensions. So that's your first for the whole of your 2020 move. That's your first fib, and the second fib is 34.91, or for S&P it's probably about 350. So this is one of the reasons I keep selling everything either at 380 or 350 for my ratio spreads. So the idea is it would come all the way here and it will bounce off. And these are very, very important. The larger your time frame, the more important these levels are. Let's look at NASDAQ. So if you look at that, the 38% is already out the window. I mean, it's already been breached. These are simple, levels that, see, we have to watch all the levels that everybody thinks that are important. And these are very important. Again, this one is breached. Okay. Actually, the next one would be around 11,600. The final one would be around 10,500. This 10,500 also is the channel low of the log chart that I shared a few days ago. And whenever there is a coincidence of number of, when there is a coincidence for the same price from different perspective or different tools, that would have more importance. So what do I mean by that? So if you look at here, right, the 61% is around 10,500, and you had this low is around 10,674. I mean, 150 points. I mean, in this market, 150 points is nothing. So this would be a very, very, very important level. So if this comes all the way here, we'll see plenty of buyers, and that would be a big rally. Again, that would be a lot of short covering and a lot of people getting into the market. I don't know how many people do follow CNBC. Well, these days I don't have much to do. So they have a lot of people have been talking about this 3,800 level. The reason they are talking about 3,800 level is this fib. They are talking about this fib, and some are talking about 3,500. This morning, I think David Tepper has been talking about 3,500 level. So that's what they are all, focusing on right now. All right. Oh, I think I've been talking about VIX a lot, so I'm gonna reiterate one more time. And VIX, as long as we stay below this 36, we could be moving slowly lower, and a bounce and a lower and another, lower high and a lower low for the market. But if this 36 is broken, okay, if it let's say closes, 1 or 2 days above 36, believe me, and we won't be able to trade, because the volatility is today, the high to low of ES was 100 points. That's a lot. Okay. And if this breaks and moves higher, everybody is going to start panicking. So far, there is not a lot of panic, even though there is a lot of destruction in growth stocks. There is still no panic. So, but so far, every time it tested 36, this is what I have been saying, and every time it came to this 35, 36 level, it came and then the market bounced. So that's what I'm expecting again this time. And then what traders do is that they're going to do the same thing again and again and again until it does not work. So far, this has been working, and we are in the weeklies. So that's 1, 2, 3, 4, 5. 5 touches so far. Every time it touched, we got a big move lower. And so the average wicks, this is why how it's calculated. The average wicks for the last 20 years is about 20. So the first standard deviation is around 28, and the second one is around 36. So if this breaches 36, and the next bigger level would be 44. And looks like a lot of people do just trade based on wicks, and above 44 is about 52. So it's 8 points, one away from the other. Those are the standard deviations. And as I was saying, with the average move for S&P 500 is about 0.1%. That's the daily average move. So 1.1 would be the first standard deviation. So for 36, that would be the third standard deviation. So that will be around 3.3% move to be expected in S&P 500 when VIX hits 36. So somebody was asking me about why VIX isn't moving higher. VIX moves higher when the price swings are much bigger. So I was saying that during this period, we can actually go when was this? 16th. Oh, these are weeks. I can show it to you here. You were asking how big the moves were during 2020. So if you look at these moves, this one, you can look in the tooltip right here. It says percentage change is minus 0.957. So that's a down 9%. And here it's 10 point, it's almost 11%. And that's only 5%. That's about 5%. So these could get worse, but again, this is not normal, obviously. So right now, they are somewhere between 3, I would say 3 and 3.5% right now for S&P for S&P 500. However, for Nasdaq, the moves are much bigger. I think until today I did not talk about this. I don't watch VXN a lot, but that's the volatility for Nasdaq. And there has been much bigger volatility for Nasdaq anyway right now. And look at, it's at the highs of 2019. That's 2020. So if this breaches 44 or 48, I would say 44. Yeah, that's when the panic. So my opinion is, if we get that panic, we are very near to the bottom, and the things will move really fast. Well, in the big picture, I guess that's all I wanted to talk to you guys about. Do you have, well, let me know if you have any questions, and I'll go through them. Yeah.
Yeah, general questions. You have been saying this panic selling for a while, right?
Yep.
And then it'll move fast. So already most of them are 75 to 90% down, and even mega caps are 50 to 75% down.
No, they're not. They're not. Mega caps haven't been. If they were down,
I'm not talking about Apple for sure, but if you see, like, they're almost close, right? Like, Facebook, or Nvidia, and then even Amazon, it's almost close.
See, if everything is down 40%, S&P would be down 40%, right? So it's not yet. I think it's around 17% right now. So S&P is part of all those companies. So there are still companies that are still doing good, obviously. So
okay, so what maybe I am seeing at looking at is growth stocks and tech stocks then.
yes, that's true. But we should also look at how well they did since the last correction. So look at that. I mean, that's your QQQ. It went from 26 to 400. Does it even feel like a correction at all? When you look at the monthly chart, it does not. And look at these corrections. These are really big corrections. And you haven't seen anything like that at all. We probably saw 1 month down here and another big 1 month down here, probably one here. That's it. At some point, there will be correction.
But
Again,
even
we don't have to fight the price. All we can do is find out what the price is doing when when we know that stocks are turning around. That's when we can get in. Until then, and I know Amazon went down a lot. Look at that chart. So it went from $5 to 3,700. This doesn't even feel like a correction, does it? So again, this is a log chart. Maybe that's.
but Nasdaq is already I don't know exactly, but 28 or closer to 30%,
Yeah,
right?
around 27%. Yeah, 27,
Yeah.
28%.
So
Yeah,
why do you say that that's not a correction?
it is in a bear market. It is in
Yeah.
a bear market. No, I mean compared to how much it went up.
Okay.
So 680 to 4,800. These are abnormal results. Again, we know the reason why this is happening. All this time, this whole time, Fed was pumping in money.
Yeah.
Now Fed is taking the money out. So obviously there will be a reversal in, I mean, the policy has changed now. So there is no other way for Fed to reduce inflation. They have to make sure that, okay, by increasing the interest rates, okay, the valuation, that's what I was talking about. For every 1% move in the 10-year treasury, you will see the prices or the valuations come down by 20%. So if the stocks go down, right now the biggest problem is very low unemployment and a huge wage increase. So for that to stop, these companies have to stop hiring. The only way they can stop hiring is when the stock prices go down. I mean, their plan is simple, but this is not going to be easy. I mean, the way and every day the way the market is moving lower, whenever it is supposed to do something and it does not do, in this case when it's supposed to bounce a little and it's not bouncing at all, that's the most bearish thing that's possible. That's what's happening right now. And for me, that's one of the reasons I'm worried to even go short or go long, because I don't see any signs right now. We might be too late for the shorts. I mean, the one regret I had was we had the short on IWM. I should have, stuck with it. It keeps moving lower. It doesn't matter how the S&P and Nasdaq are doing. This keeps moving lower. But again, that's trading. We will always have regrets.
Yeah. So the IWM is, you said, I think 160, you said, right? Sometime
168. Yep. 168 is the trend line. And we also have some gap. High is what? 165.58. So that's where the high of the gap, low of the gap is.
Yeah. So is there any chance that it can go below 164?
Oh, it can go all the way here. Anything can happen. See, the problem with these Russell is right now, they are all domestic companies, they are all small companies. And when there is not a lot of availability of money, okay, their business is screwed. It's hard to do business for small businesses when there is not a lot of liquidity available. Think about this. The guy would have got a business loan, 5 months ago, let's say for 6% or 6 or 7%. Now it went up to 9 or 10% right now. I mean, business loans are a little expensive because there's not always some kind of collateral. So, but I mean, I used to have a business account. I was paying about 6%, I think, 2 years ago. But anyway, my point is, when your interest rates go up, you would want to cut down to just survive. So that's
Yeah.
what's happening right now. And these companies are gonna, and they won't have a lot of money to survive, or the cash flow or the cash set aside, like Apple and Google and all those big companies.
Yeah, so that's why I was asking, because when IWM goes down below 164,
Yep.
then it will be a problem for the lot of small business. So would there not be an economic problem again?
Yes, it is. Right now, that's what the market is discounting right now. I mean, I don't think the businesses are seeing any problem right now, but they will. That's what the market is, at least 6 to 9 months earlier than what's happening in the economy. So market is discounting all those foreseeable problems into the stock price.
Yeah, and my next question is, I mean, we can wait for until tomorrow morning, but what are you expecting if the
CPI?
CPI is below 8.5 or 8? Do you
Yeah.
expect a bear market rally or?
Yeah, I would think so. Yeah. There are, it's complicated. I mean, that's not straightforward either. Let's say we get a smaller CPI, okay? Then will the Fed cut? Right now, market is expecting 250 basis points. That's what the Powell said in the last Fed meeting. And Powell might think, if let's say if it's only 7% or 6%, market may like it and starts moving higher, because thinking that inflation is coming down, and the reaction from Powell could be that I don't have to do 50, I would only do 25. So we don't know yet. We'll see. And again, the print is not important. I'm telling you, print is not important. The reaction to the print is the only thing that matters.
Yeah.
It's the same case with jobs report, any report, because what we think. So okay, this point is very important. When the print is really worse than what we expect, and if the market rallies, that's when the bull market starts. So it is so bad, it would be good, because we have been through worse, and the only way is up. I remember, I mean, I think it was in 15, I think. Is it 15 or 16? 15 February, I think. That's when, I mean, there was some really bad news, and the market started, I think it's 16 February. And market started rallying. I mean, that happens. So again, the reason we won't miss is because we're going to watch the price. We're going to follow the price. When the price does good, and when we see our setups, we'll get into those setups. If we start making money, we'll add more. We have very simple theory. We don't have to worry about all these economic reports at all. But understanding what's happening in the economy, it will make us a little better, I guess, in making decisions. Excuse me.
Thanks. And then I think I hear a couple of numbers, but I think by year end it is a 250 basis point, right? Or 2.5%, right?
So those are all expectations right now. Let me go.
But somewhere I saw 3%, but that's huge.
I don't have the chart. I think I read it somewhere. So it's not just okay, but the wage inflation in 1970s from 1965 to 80, I think for about 15 years, the wage inflation was more than 6%. Okay, during that period, market was all over the place. Let's see. I think this is the time, right? So this is when the inflation was high. Look at that roller coaster. I mean, I know that they are months, but look at that. We even had 150% correction right there. Even though from 60s to 80s, that's how much is that? $60 to 140. I mean, it tripled in 20 years, the market, but we had these huge corrections. This is the only year that is much similar to conditions right now. And again, we don't know if this is what we are going to see, but history says that, if we get a 50% correction, I would say there is nothing better like it. Or else this could drag along. I mean, this one is what? 73 to 74 October, right? So, that's almost a year and 10 months, 22 months. Oh, that's long. That's long. That's long. So I was thinking that was smaller, but it's not. But I mean, this one is even worse. I think that's the high March, and 1, 2 years, 2 years, and probably 26 or 28 months. So this is even worse. We don't want this. But I mean, no matter how much conversation we have, it's good. But whatever is going to happen is going to happen. There are certain things, a lot of people that are looking the numbers that they are not encouraged by is the amount of investors, retail investors getting into the market. ARC last week, I think, on one of the day, or is it, there were like 900 million inflows into ARC fund. I don't know who is buying. I mean, it's down 70% right now, right? So that has to stop. Until that stops, until that retail money stops, there won't be an exhaustion.
Why do you think retail money?
Who invests in RK? Obviously, it's a fund, right? I mean, only retail money comes into the fund. Funds would buy their own stock. They wouldn't rely on other funds.
Okay.
So,
but institutions don't buy it.
Why would they? No, I mean, their institution's job is to figure out which one to buy, not the fund, right? I mean, they even if they buy, it would probably a small sliver of it.
Okay.
Yeah, I mean, it's not far from its 2020 lows. Look at that. And I don't know how to, add the NASDAQ chart on this one, but this one looks much similar to what happened in 2001. Not the NASDAQ. I mean, not the current. Okay. When you compare RK from NASDAQ in 2001, this is exactly what it looks like. And it went down 90%, I think, 90 or 80%, I think. And you might know that stocks like Amazon, they all went down 90% at that time.
NASDAQ went down 90%?
80. Yep.
Oh, man.
Yep. And I know we do, I mean, even in especially Bitcoin and Ethereum, right? When things go up thousands of percent, right? Even if it goes down 80%, it is still, much higher price point. So when is this weekly? That is why we have to just wait until things get better. That's 16. What is that? 11, 12. Look at where it is. It's $30. This is up Wow, it's up 100 times. Amazon is up 100 times. I mean, it's down 40% and it is still up 30 to 2000. That's what, 70 times? So think about that. And this one was a crazy move. And that's also another thing. A lot of people, they own Amazon, Microsoft, Apple, I don't know about Netflix anymore, Tesla. So these have to come down. The two stocks that have to come down is Tesla and Apple. They have to come down. You want a flush, that's when the flush happens. Tesla and Apple. They both look alike.
You mean for the S&P to go down?
Yes. I mean to have that final flush.
Yeah.
And for the market to turn around. Yes.
I agree, KP.
But it is so surprising that Tesla didn't go down much in the last 3 days.
I mean, it is still down about 35% or 40% right now. 30%, 35%, I think.
But yeah, usually it goes down a lot.
This thing is I mean, it's not easy to trade anymore. I mean, look at those, sloppy moves. And these are the conditions of the top. It moves up a lot and moves down a lot. And yeah, I have a friend. He was asking me where does it end? And I said the first support is at 550 and next one is at 330. And he's like, what? 330? I mean, that's how all the markets have been doing. Even at 330, it is what? It is still in 2020, mid 2020 range. So this happened really fast. This is what, 300 to 1200, that's 400% in a year.
Yeah, the 330 is the after the split, right?
Yeah, this is
right exactly right around the split.
Yep.
That was just last year. Yeah.
Yep. So I mean, it went up 400% in a year after moving a lot.
Yeah. So I have a question here. I had this 330 question, right?
Yep.
Do you have that 330 as support because of the split or because it's only one touching, right?
No. It's because of the support. I mean, that's where you have that swing low. You have a swing low here. These are the major swing lows. It doesn't matter whether it's a daily or weekly or monthly. These are going to be prominent. So this is what the long-term investors are looking at. That's an important swing low. This is an important swing low. This is probably another important swing low.
Okay. Okay.
Yeah. I don't know. I mean, if this goes down for another 5 months, it's going to be really hard just to watch.
Can you show us the Apple, KP? Just real quick, just like this.
Yeah.
I think if Apple comes down, I mean, I'm sorry, I'm not trying to be offensive for the stockholders here, but I think, like you said, I think if S&P can correct, I think that would be a really good opportunity for a lot of us actually here in this group.
That is true. So let's get rid of the gap. Is there still a gap?
Yeah, look at the Apple chart. It's insane. It didn't even
budge,
flinch. Yeah,
at all. It's still crazy. And fundamentally, it would make sense when economy slows down. Who is going to buy iPhone or the services? They're getting rid of Netflix and everything. Eventually, they will get rid of Apple Music. This inflation, the longer it stays, all the money is going to go for food, just buying food. We all know how expensive it is right now. So you're talking about the major. This one looks important. This one, so that's 138. And that's 122. And Apple had 3 corrections that are about 33%. So even in that scenario, it would probably come down to at least to this 122 level.
Yeah.
Or probably 116. But still, that's not a lot when you compare it with Amazon or Google and everything. That's not bad at all. Next one is 103. It depends on how worse this could get. Yeah, if it gets worse, this could go down 50%. And I think in 2008 it went down 50%. Apple did. Is that 18? And last 20 years have been a boon for these companies. So it was at, of course, this is because of the split, but $7, $3. So it's more than 50% correction in 2008. This is what I was talking about. This November 17 is when it bottomed. Let's see what's the low here. 283. 279. That's it. That's a double bottom. And that's it.
And KP, another quick question. I'm sorry to interrupt here. I was looking at the S&P, right? So I did something last week. I was gonna call you. I didn't get a chance to. I didn't want to bother you. So the last week S&P put premium. This was on Thursday, right?
Yeah.
It was around $6 something, $6.40 or something, right?
Which one is that?
Which for the 407 puts.
Which expiry?
This week, this Friday, this coming Friday, 13th of May.
Okay.
So if you look at today, it's actually the premium went up for both the puts and the calls.
Yeah, I mean,
which was very shocking to me.
that's because of the VIX. I mean, every time the VIX go up,
okay.
Every time from last week, the VIX has gone up. This is what I was saying. 1, 2, 3, 4. This is the 5th day of making a higher low. So every time this goes up, the premiums go up. And if I remember in 2008, I had Chipotle calls. Okay, market went down, Chipotle went down, my options went up. I was surprised, but I got out, of course. So I mean, when the volatility shoots up a lot, the options go up, and sometimes if you are selling anything, or even though that's against you, the market, you won't make any money. So to the direction is probably the best thing to do. And I really don't like this. I mean, when it's moving this way, if it weren't VIX, this says that you have a cup and probably this is a handle and probably a breakout. I don't know if that's going to happen, but yes, from last week, the VIX has went up a lot. Yep. And that's also one of the reasons why I'm doing 1:3, the ratio spreads. All right.
Got it, KP.
Sure. Any other questions, guys? Let me pause the recording.